Quite a few of you already know me as a tax practitioner. Today, I decided that, okay, let us do an experiment. So, the latest episode of GCC Tax Theater that I wrote, what I intend to do is to narrate it and see how you respond to it. If you like it, let me know so that I can do it again and again for the benefit of those who are looking for that kind of guidance. So, here it goes. So the name of this episode is GCC Tax Theater, UAE Corporate Tax, the Armageddon of Mankind, Technology. Uh, I'll be back, said the T-800 Terminator, and went down in flames of melting metals. A noble thing to do, knowing what mankind would do to itself if that technology fell into the wrong hands. Was it really only a movie? Or was the story writer already aware of the prediction of Stephen Hawking, who had said the development of full artificial intelligence could spell the end of the human race? Well, we'll leave these questions to the superior minds like Hawking's and come to the boring topic of today for people like us, the CEOs, the CFOs, the chief tax officers, and the frustrated regional managers sitting in European, American, and other parts of the world, uh, worried about their UAE entities, tax exposure. While I cannot save the world from T800s, the least I can do is guide you about what to do with your UAE technology company's tax affairs. I hope that works. Before we delve into the specifics, let's have a look at the different types of businesses that can be termed as technology companies. Now, broadly speaking, these can be categorized as follows. Number one, the hardware companies. Now, these hardware companies manufacture physical technology devices such as computers, smartphones, and networking equipment. Examples include Apple, Dell, Cisco. Then we have software companies with these companies develop and sell software products or provide software-based services. Examples include Microsoft, Adobe, Salesforce. Semiconductor companies, you must have heard, this is another type of technology companies. They design and produce semiconductor chips used in electronic devices. The examples include Intel, AMD, Nvidia. Who hasn't heard about the internet and e-commerce companies? They provide online services including search engines, social media, and online marketplaces. And the examples are they include the infamous Google, Facebook, which is Meta, Amazon, etc. Telecommunication companies are also a type of technology companies. They naturally offer communication services as a mobile, internet, and TV, organization. And the examples include AT&T, Verizon, Vodafone. Then we have cloud computing companies as well. They provide cloud-based infrastructure platforms and services. Uh, Very famously known name Amazon Web Services, AWS, Microsoft Azure, Google Cloud, etc. Then a very rising market, fintech companies, another type of technology companies. They combine technology with financial services to innovate banking, payments, investments, etc. Examples include PayPal, Square, Stripe. Then we have biotech and health tech companies as well, which are another type of technology companies. They develop technology for medical and biological applications, including medical devices, health monitoring software. The examples include Illumina, Medtronic, Fitbit. My favorite, artificial intelligence and machine learning companies. They specialize in artificial intelligence and machine learning solutions and platforms. Who hasn't heard about OpenAI, ChatGPT, DeepMind, IBM Watson? Before ChatGPT, it was IBM Watson that was ruling the world. But anyways, then we have another type of technology companies, which are cybersecurity companies. And examples include Symantec, McAfee, the antiviruses that we use usually. They protect data systems and provide defense against cyber threats. Uh, we also have networking and infrastructure companies. They develop networking hardware, they develop networking solutions, software as well for communication and data exchange, like Cisco, Juniper Networks, Artista Networks, etc. Then we have consumer electronic companies as well, which produce electronic devices for personal and home use, including entertainment systems and smart home devices. Examples include Sony, Samsung, LG. Then we have a very interesting area of technology business, which is autonomous and electric vehicle companies. They focus on development of self-driving and electric intelligent vehicles as well. Examples, everybody knows Tesla, Waymo, Rivian, etc. Then robotics is another very rising market, and those companies develop robots for industrial, commercial, and even personal use. uh, the world famous Boston Dynamics is ruling this market segment. iRobot, Fanuc, etc. These are the companies which are into robotics. Another type of technology companies are edtech, educational technology. Edtech companies, they provide solutions for educational purposes, including online learning platforms and educational software, for example, Coursera, Khan Academy, Blackboard, etc. Then we have another type of technology business, which is augmented reality and virtual reality companies. Now, these provide, as the name suggests, augmented reality itself and virtual reality. I think it is there in every home now, the VR provided by various companies. Oculus, which is Meta, HTC Vive, or Magic Leap, etc. Now, these were, I just described 15 or 16 categories of technology companies. Uh, uh, what we are going to do in the rest of the vlog is we will try to examine the tax implications from both the type of technology business as well as the supply chain that applies across it. We shall also explore how tax compliance is triggered across the technology supply chain and what are the factors to consider while we strategize on the tax congenial corporate structures and the modus operandi of these businesses. Now I'm going to give a detailed tax exegesis of the technology business. And we'll start from a very important area because these supply chain areas are common across quite a few of these technology businesses. So the first aspect to consider is research and development, R&D. R&D involves innovation and development of new technologies and products and warrants significant amount of investments in intellectual property, patents, prototypes. Now, R&D is far more the lifeblood of technology sector than any other sector. The speed with which R&D is taking place in technology is faster than any other business on the planet. Organization for Economic Cooperation and Development, which is the biggest body of the world, which provides guidance on tax related matters, tax related affairs. They have published rigorously researched material on the impacts of R&D expenditure, and they have proposed mechanisms of allocating fair taxing burdens on the constituent entities of larger multinational groups. So one entity would be involved in a lot of R&D, creating intellectual property assets, and other entities would be involved in selling. Another type of entities would be involved in the maintenance of it. And when we tax the whole group, how much tax burden should go to the entities which were creating these assets, how much was should go to the selling arms of these groups, and how much should go to the support arms of this group. That guidance has been provided by OECD. Now, in UAE corporate tax framework, some provisions are already existent regarding qualifying intellectual property. For example, the first thing is the decision that addresses this area. Uh, that decision has first described what exactly is qualifying intellectual property. So, qualifying IP typically refers to patents, copyrighted software, and other intellectual property that is legally protected and used in the business. The this definition may also include certain criteria that the IP must meet in order to qualify for the tax benefits. Now, there are certain exemptions and incentives as well. UAE does offer incentives for income derived from the qualifying IP, especially for businesses engaged in innovation and development activities. Specific free zones in the UAE, such as Dubai's DIFC, Dubai Silicon Oasis, and in Abu Dhabi, there's 2454 or Kiza. They offer quite a lot of subsidies and reduced costs, etc. In the qualifying IP business. Taxable persons in the technology sector can deduct expenses related to development, enhancement, and production protection of qualifying IP from their taxable incomes. This includes costs which are associated with the R&D registration. It may be fees, legal expenses for protecting IP rights, etc. Naturally, usually these IP assets are managed by very large organizations, and there's a whole network of related parties that is interacting. One is like producing the IP asset, other entities are selling it or facilitating the supply chain of that. So transfer pricing regulation becomes very relevant. Arm's length pricing becomes very relevant. One entity which is selling the right of use must sell that on arm's length, etc. There may be certain withholding tax implications as well, but we all know that in UAE there is no withholding tax on payments as such. But those entities which are operating qualifying intellectual property out of UAE, may be exporting. So when they're collecting revenues, there may be withholding tax implications. Saudi Arabia deducts some tax, for example, withholding tax. So does Oman and other countries. Economic substance regulations has a part to play in this. Those companies which are involved into IP business are definitely subject to ESR in UAE. They must demonstrate substantial economic presence in the UAE by meeting certain criteria, such as having adequate employees, office space, expenditure, etc. Now, gains from the sale or transfer of qualifying intellectual property may be subject to corporate tax. Okay. However, naturally, there is certain exemptions or even deferrals that might be available that we will address in the unrealized exchange and unrealized gains and losses on intellectual property. Now, because of the cross-border structures of intellectual property business, quite a lot of times there are multiple countries involved. So withholding tax deduction related matters come in, and that's where the double tax agreements pitch in. So, for example, between Saudi Arabia and UAE, there is a double tax agreement, and there may be some subsidy available or for a reduced withholding tax deduction, etc. So, double tax agreements become very relevant in the IP business or R&D asset business. So that was one part of the supply chain. Let us talk about raw materials, because technology business is not all about only hardware, only software. There is a very big part of the technology business which revolves around hardware. And when you're manufacturing, when you're uh, there are production facilities, you have to import raw materials, you have to put the inputs into production. So technology businesses heavily rely on sourcing essential materials such as semiconductors, rare earth metals, plastics, and other components. So this often involves mining as well, refining and manufacturing of base materials. So from a tax perspective, if you're a technology business importing raw materials into UAE, then in addition to the VAT reverse charge mechanism, you might want to look at the supplier from a transfer pricing perspective as well, especially if the supplier is a related party. I shouldn't use the word especially if the supplier is a related party. If it is not a related party, then no transfer pricing implication will arise. Uh, in the event that the ultimate decision maker for example, a mining company, you're doing mining in another country, taking out rare earth metals, but the shareholders are sitting in UAE. That's where the doctrine of place of effective management pitches in. And to your surprise, that company which you have incorporated somewhere in South Africa or Brazil or somewhere, because the ultimate decision maker is living here in UAE, that company will become a resident company of UAE. Interesting? I know. So, but that is a provision of the UAE corporate tax. That company will need to be registered here, by the way. So when it comes to mining or environmental cleanups, etc., so usually in the financial statements, such companies, they have to either out of legal compulsion book the costs of cleanup, environmental cleanup, or sometimes it may not be legal compulsion, but because of their past actions, they have demonstrated that there's an expectation built up on the community, and and the auditors propose that you have to book this provision for this environmental cleanup, which is called a constructive obligation under IAS 37. So those provisions, they hit your profit for the year, and they are tax deductible if you are complying if you are compliant with the international financial reporting standards. So it will be deducted for tax. Let us go to another part of the supply chain for technology businesses. Component suppliers. So many technology companies are manufacturers that produce individual parts of computing or other machinery. For example, microchips, for example, circuit boards, sensors, displays, batteries, and more. Now, these suppliers often operate globally, with some specializing in highly specific technologies. So, tech companies in component manufacturing, they serve as the heart of the technology business and are often scarred by the frequent technological redundancies, which can attract impairment provisions, such as if there is an impairment, then the International Accounting Standard number 36 for impairment comes into play, and you have to book an impairment provision, a loss. Which it is allowed. The deduction of this loss is allowed if it is compliant with the IFRS. Similarly, related party transactions, and in case of large transnational organizations, more advanced aspects such as the BEPS Pillar 2 provisions may apply. Think about Intel, for example. Now it's a semiconductor company, or now Nvidia, which develops AI chips, etc. These are giants. So these companies, naturally, they're earning far more than 750 million euros, which is a criteria for a multinational enterprise. So they will be subject to Pillar 2 provisions. Pillar 2 is a framework that has been agreed by the nations of the world, and it has been proposed by OECD, and 15% effective tax rate applies. Now, other than that, one more very important aspect I should tell you about this. Now, manufacturing and processing, these are two activities, and to those companies which are involved in manufacturing or processing and operating within UAE, there is good news, because both of these activities have been designated as qualifying activities under the UAE corporate tax law, for which conditions of setting up the company in a designated zone is not required. That's a very good news. So you can have a company in a simple free zone, and it would suffice. You will still be able to earn qualifying income and pay zero rate of tax, provided that you meet other conditions. So that's that. That was another. That was the component suppliers related area of the supply chain for technology businesses. I'm going to come to the next part, which is hardcore manufacturing. That was the previous one was only semiconductors or component manufacturing, right? Now we're coming to the finished product manufacturing. A large part of technology supply chain comprises of companies that perform assembly of components into a final product, such as smartphones or computers, servers, other electronic devices. Now, this stage can involve both in-house manufacturing and outsourcing to third-party contract manufacturers. Now, we've all heard about Apple manufacturing their iPhones in China, haven't we? So similar arrangements can be done either by way of contract manufacturing or toll manufacturing. Now, in contract manufacturing, what happens is that a business uses another company's production facilities from procurement to the emission of the finished goods, from procurement until finished goods, another company's facilities. But in toll manufacturing, the parent company supplies the manufacturer with raw materials, design, and it retains a kind of degree of control over the production process and supply chain. So that's the difference between toll manufacturing and contract manufacturing. The interesting part is both are qualifying activities. Now, as I had mentioned earlier, manufacturing as well as processing as service both have been designated as qualifying activities under the UAE corporate tax law, for which the condition of setting up a company in a designated zone is not required. And even a simple free zone would suffice to give rise to qualifying income, which is zero rated for the purposes of corporate tax. Quite often, the technology companies manufacturing a product also sell the product in open market. Now that is a different ballgame. That has been addressed ahead under distribution. We're going to come to that part of the supply chain, distribution. That's very stringent. Now I'm going to come to another aspect of the technology business supply chain, which is testing and quality control. Now, this is a specialized area of technology supply chain, and it constitutes rigorous testing of products to ensure that they meet the requisite quality and safety standards. Such companies offer software testing, hardware durability tests, and compliance with regulatory standards. So, since these are service entities, these companies are not eligible by default for zero rating of corporate tax, no matter where they are registered, whether it is a free zone or a mainland, they will be by default they will be subject to tax. However, there is some good news still. If such service companies they want to aspire, they want to become a qualifying free zone person, what I suggest is that they should conduct an analysis of their customers. Find out how many of your B2B customers are free zone entities. Why do I say that? Is because when you generate enough revenue from free zone customers or clients, then you should think about either splitting that part of your company and moving it to a free zone, or you know uh, uh, setting up entirely a new business, or you can move the entire company into a free zone. Okay, if the other part, other customers in the mainland or export are too little, we call it de minimis, but we'll talk about that later. But the point is that if you are a service entity and majority of your customers are also free zone customers and you are in a free zone, then your income will become qualifying income. So free zone seller, free zone buyer, B2B business, that will give rise to qualifying income. So that was the strategy basically. Now let us talk about the biggest pain point, which is the distribution part of technology business. Now, logistics and transportation of finished technology projects from products from manufacturing facilities to warehouses, retailers, or directly to customers requires coordination with the shipping companies, freight services companies, third-party logistics companies, and naturally customs and regulators, etc. Now, this is the biggest part of the technology supply chain in UAE and has attracted huge discussions and arguments. The UAE corporate tax law has introduced qualifying free zone person regime, which grants zero rating to qualifying income of such distribution companies. To facilitate this part of the supply chain, not only for technology business, but actually this exemption, this facility of zero rating is available for all types of businesses, not only technology businesses. However, there are stringent conditions that are applicable, that are needed to be complied in order for a distribution company to become a qualifying free zone person. These conditions include setting up camp in a designated zone, first of all. It's not a normal free zone. Only 24 zones have been published by the Federal Tax Authority as designated zones. You can download this list from the FTA website directly. It is available. And these companies should not sell to either natural persons or consumers. There can be companies also who will act as consumers. So consumer, people misinterpret the word consumer. They think that we are only talking about natural persons like you and me. No, there can be a company which is also a consumer. Okay, so if a business is selling something, distributing something to a consumer or a natural person, then you will not be able to earn qualifying income. At least that part of revenue will not warrant or will become eligible for qualifying income. There are other conditions as well. For example, such a company which is involved into distribution, they should have adequate economic substance in that designated zone. You will also be required to maintain audited financial statements. You will also be required to comply with transfer pricing regulations. And there is something called de minimis. Now, the word de minimis, what does it mean? It's a Latin word meaning too small to consider. And in the context of tax, it will mean too small to tax. Now, what would be de minimis in the perspective of qualifying free zone person? Let's say this one free zone person which is set up in Javza, which is a designated zone. They are earning revenue, and some part of their revenue, maximum how much? 5%. Up to 5% of the total revenue is being generated from, let's say, natural persons or consumers, which is not a qualifying activity, which will ordinarily or by default be taxable, right? But since it is only up to 5%, FTA will ignore this. They'll say de minimis, too small to tax, right? But it's not only 5%. There's another condition that it should be either up to 5% or AED 5 million, whichever is less. So if your revenue is if your revenue from such activities which are not qualifying activities is up to 5 million of your total revenue or 85 million, whichever is less. So that is the de minimis limit. If you exceed this limit, if instead of 5 million you sell, let's say 5.5 million, then your entire qualifying free zone person possibilities are gone. Or even if it is less than 5 million, but that part of your income is, let's say, 6% of the total revenue. Again, you are at a loss because you will not be able to become a qualifying free zone person. Now, majority of globally popular technology products today are being manufactured in China and later imported by various countries, UAE being one of them. If a distribution company in technology business is set up in a UAE designated zone and it sells only to B2B in such a manner that once the goods have been manufactured in China, they don't bring the goods into UAE. They send directly from China to Africa or Europe. This is called third port sales. I'm sure you've heard about it. Or sometimes it is called high sea sales. So good news is that third port sales will still be a qualifying income. Okay, but and please guys, you should know that this is a very tricky topic. So take consultation from those tax advisors that you trust. You know that they are good, and there are very good tax advisors available in UAE. Reach out to them. You want to reach out to me, I'm available. But if not me, any tax advisor which you know that this is a trusted, technically sound tax advisor, reach out to them, because otherwise you will face serious amounts of fines if you violate these provisions, and you might end up paying uh, tax which you could have saved because you were maybe meeting already quite a lot of conditions and criteria. Anyways, now let us go to another aspect of the technology business supply chain, which is retail and sales. So, sales channels for technology businesses include online platforms, physical retail stores, authorized resellers, etc. Now, marketing, customer services, sales support, these are all very crucial at this stage because this is, reaching out to the consumer or the end buyer. So you can, companies, technology businesses either do it by way of having an internal department, insourcing of this function, or they can hire third parties as well to conduct the retails and the sales. So, from a tax perspective, selling to consumers can be tricky if you are an aggregator or an e-commerce platform. Now, because e-commerce is on the rise in this region, the Middle East region, there are predictions of 15% year-on-year growth. So, it is very pertinent to mention e-commerce here. Now, I have personally seen contracts of aggregators who have clearly put the onus of consumer sales leg on the merchandiser. So, for example, there's Amazon, right? There's a merchandiser who has enlisted on Amazon and then he's selling his merchandise through Amazon. Amazon is an aggregator. So, what they did was when the merchandiser wanted to register with Amazon, they made him sign a contract. And in that contract, that merchandiser agreed that these goods that I'm selling, these are my sales. Amazon has nothing to do with that. So fine, Amazon controls the whole thing, quality controls or makes sure that the customers remain happy, etc. But the sales transaction will be between the merchandiser and the customer. It will not be between Amazon and the customer. Remember this point. And by signing this contract, those poor merchandisers who are making those sales, they're not even aware that actually we are the ones who are actually the sellers in this scenario. They think that okay, Amazon is the seller, which is a misconception. And I have seen such merchandisers in a lot of pain later on, particularly especially from a VAT perspective also because they don't know even that whether they have to raise a tax invoice at all or not. Various implications arise. So it is very important that you should reach out to tax consultants, take advice on your scenarios, because otherwise, if you don't do that, there can be a lot of repercussions, and you might find yourself in a huge amount of trouble. Anyways, after the sales stage of the supply chain, then another aspect comes in, which is the after sales support. So, technology businesses usually require services such as technical support, warranty claims, repairs, upgrades, etc. So ensuring customer satisfaction and maintaining brand reputation, that's the objective of this function. Companies offering this can either outsource this function or again have an internal department for it. So from a tax perspective, these companies offering those companies which offer outsourced or third party after sales support, the revenue would be B2B. Why? Because those companies are going to do a contract with the original supplier, original seller of those merchandise. So it will be a B2B contract. So free zone seller and free zone buyer scenario holds good in this. So you should look at it whether the entity that you are doing a contract with, are they even present in a free zone? Because if they are present, then you should do this arrangement within free zone and then it will become your qualifying income. Another aspect of the technology business is recycling and disposal. Now, technology businesses are required sometimes both from a legal and ethical perspective. Environment is a big, issue nowadays. You must have heard about the COP28 that happened here. ESG is on the rise. So, a lot of rigorous monitoring and control of end of life management of technology products, including recycling and environmentally responsible disposal of electronic waste. We call it e-waste. Technology companies often have programs for take back and recycling to minimize environmental impact. I've seen videos in which BMW is taking old cars and then smashing them and collapsing them, making them a disposal. Same thing Apple also does. Used Apple's MacBooks, etc. You can trade in for new MacBooks, and Apple kind of either refurbishes if it is good or destroys that old Apple machines, etc. And they have to take care of the environmental costs around it. So large techno companies usually book constructive obligations in their profit and loss account income statements, and if they are in compliance with the IFRS, particularly there's a standard called IAS 37. If you are complying with that, then these expenses will be tax deductible. Similarly, there may be a question that what do we do with this scrap sale? If there's an income coming from the scrap sales, is it taxable or is it is a taxable income? It will stay part of your taxable income. Now, I'm coming to the last part of this episode today, and that is the supply chain management and coordination. If it is not technology businesses which would entirely stand on the in-house use of advanced software and technologies to manage and optimize their supply chain, then who else would do that? These are technology businesses, and charity begins at home. So yes, technology businesses domestically also use extensively technology to run their businesses, and in doing that, naturally the large ERP systems, you must have heard about SAP HANA or Oracle Financials, etc., or JD Edwards and all that. So these large ERP systems, which now extensively use artificial intelligence or Internet of Things, they are needed to optimize the supply chain. So their apparatus involves demand forecasting, inventory management, state-of-the-art inventory management, supplier relationship management, risk mitigation. Now things are RPA is kind of becoming an old thing now. The world is moving so fast that robotics process automation is also now it is being overridden by the use of artificial intelligence. So things are very fast in technology business. So this service revenue that the ERPs would charge other technology businesses, it will be a taxable income. But again, service to service, we need to see the free zone seller, free zone buyer scenario, where there may be a possibility to earn a qualifying income and pay zero rate of tax. So large ERP houses are usually multinational enterprises, and they fall prey to death pillar two provisions where 15% effective tax rate needs to be paid. Transfer pricing provisions and compliances and documentations are also required, master file, local file, etc., country by country reporting, everything. So generally, this was a quick overview, maybe not quick that much, but still a very detailed overview of the technology business. I hope you enjoyed hearing my 2 cents of contribution to your technology business. Hope to see you again. Keep following the hashtag GCC Tax Theater on the LinkedIn. And thank you very much. Take care.